Welcome to my channel. I'm Scott and I'm going to walk you through the process of valuing Suncor stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. In case you were curious, I am back full time. I'm going to do a DCF video every single day, just like the good old days. Suncor's specialty is the production of synthetic crude from oil sands. Oil sands is just one of many ways to extract oil. The sand is taken from the ground and put into trucks, which are brought to crushers where the large clumps of earth are processed. Once the oil sand is crushed, hot water is added so it can be pumped to the extraction plant. That is the upstream part of the oil and production process. Since Suncor is an integrated oil and gas company, it is also involved in the downstream part. When you hear the word downstream, that's the refining and marketing part of the process. The company is headquartered in Calgary, Alberta, Canada, and was founded in 1919. The ticker trades on the TSX, New York Stock Exchange, Mexican Bolsa, Deutsche Börse, and Swiss Stock Exchange. Let's get started with the model. This is a large cap company, 55 billion market cap. They're trading at $42 a share and they have 1.3 billion shares outstanding. Since this company reports their financials in Canadian dollars, we're going to look at the ticker that trades on the TSX. So most of the numbers in this video are in Canadian dollars. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have a ton of free cash flow in 2022, over 10.5 billion Canadian dollars. Because the success of this company has a lot to do with the price of oil. When oil prices are high, they make a lot of money. And when oil prices are low, like in 2020, they lose money. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that was also highest in 2022 at over 9 billion. Revenue is the sales for the company, and that more than doubled from 2020 to 2022. It's close to 60 billion Canadian dollars. This is the company's income statement. The top line is the revenue, the sales. Below that is a cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. Look at their gross margins in 2022, about 50%. They converted nearly half of their revenue into gross profit. You can see in 2020 it was only about 25%. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. An example of this is marketing. Gross profit minus operating expenses give you your operating income. And they had more operating income in 2022 than the sum of 2019, 2020, and 2021. Below that is the interest they pay in their debt. They do have a lot of debt, so they paid over 1.1 billion Canadian dollars. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. If it's negative, it's likely an asset impairment. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which is really high in 2022, over 9 billion. If you invested in oil and gas companies in 2022, you were rewarded handsomely. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. And they do spend a lot on CapEx. They have to build out lots of infrastructure, over 5 billion in 2022. Operating cash flow minus CapEx gives you your free cash flow. And that was really high in 2022, 10.5 billion. So they did pay a really nice dividend in 2022. They also used some of that cash flow to buy back stock. They bought back over 5 billion in 2022, 2.3 billion in 2021 and 2019. When a company buys back their own common stock, that decreases the shares outstanding and makes your shares more valuable. They also paid down a lot of debt in 2022, over 5 billion. They did pay down some debt in 2021, 1.3 billion, because they issued 1.4 billion. Let's look at their capital structure. 39 billion of equity, 16 billion of debt. They're 72% equity, 28% debt. and their net debt is $13.6 billion. Net debt is debt minus cash. And I gave them the middle whack on Finbox, 11.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $67 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $62 billion. We divide that by 1.3 billion shares. And we get a calculated stock price of $47. They're trading at $42, so they're trading at 11% discount. It's a buy according to the model. Their revenue target for 2024 is $47 billion. For 2023, it's $48 billion. I continue this downward trend into 2025 and 2026. That's how I got their future revenue estimates. To get their future free cash flows, I needed to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers and I divided by the sum of these 4 revenue numbers, and that comes out to 13%. So I multiplied their future revenue estimates by 13%. That's how I got their future free cash flows. The website Simply Wall Street is way higher than me. They're at 101 a share. They're saying the stock is 59% undervalued. 8 analysts priced the American stock, and their average target is $40, the lowest $31, the highest $54. Here's another analyst breakdown. The share price is 42 Canadian dollars, and the average 1-year price target is 54. So according to these 19 analysts, the stock is 29% undervalued. This is where the stock has been trading the last 5 years. The stock got really low in March and April 2020 during COVID. Also, that's when oil prices became negative. It looks like around the third quarter of 2020, it got even lower. But then it shot up like a rocket, about $54 a share at its peak in mid-2022. Then it looks like it fell to about $36 August 2022. And it's been a bit volatile since then. But the nice thing about owning this stock is you get your guaranteed dividend payments. And they have been raising their dividend recently. This is the stock price compared to the price of Brent crude for the last 5 years. So you can see there's not much guesswork in trying to understand where this stock moves. It pretty much tracks the price of Brent crude. It was tracking it really closely for a few years, and then the gap widened a bit, but now they're almost identical again. In the past 5 years, this stock is down 2%. The price of Brent crude is up 7%, but this company pays a dividend, so you're probably doing much better than the 7%, because you have to build in those dividend payments. Back in 2018, they were paying 36 cents a share. It dropped to 21 cents in 2020 and 2021. Then they doubled it to 42, and they increased it again to 47. Now it's 52 cents. So you do get a nice dividend, a 5% yield, which they can easily afford. 26% of their free cash flow, 30% of their net income. Here's a chart of their dividend yield since 2012. So you can see it got really high in 2020. That's when the stock crashed. The lower the stock price, the higher the yield. The higher the stock price, the lower the yield. Analysts seem bullish on the company's dividend yield. They're projecting over 6% by 2025. You can see the stock is a bit volatile. The beta is 1.7, so the stock moves more than 1.5 times the market. It's pretty much flat in the past 52 weeks while the S&P is down 10%. The 52-week low is 36, the high is 54. And the stock is trading below its 50-day and 200-day moving average. This is a pretty popular stock. Over 15 million shares have been traded each day the past 10 trading days. All the shares outstanding are on float. 67% are held by institutions, and 2% of the shares are shorted. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $14,000 today. That's a 3.5% annual return. They've done 4 stock splits since '97, all 2-for-1s. The CEO's salary is $630,000. Total compensation $4.4 million. That's in Canadian dollars. A good sign is when you see insiders buying. In the past 12 months, there's been only insider buys, no sells. 65% of the company is held by institutions, 35% by the general public, and a really small percentage by private companies and insiders. Their employee count was pretty flat from 2017 to 2021. Then it jumped up to 17,000 in 2022, and it looks like it's pretty flat in 2022. The biggest shareholder is Vanguard at 4%, then Dodge & Cox, Bank of Montreal, Royal Bank of Canada, and Sanders Capital. The best way to look at ratios is to compare them to companies in the same industry. There are 11 companies in the same industry as Suncor, and all these numbers are in US dollars. This is Suncor that trades on the US stock exchange. And there's some monsters in this industry: Exxon, Chevron, really big companies. They do spend less than average in CapEx, because when you have a company like Exxon spending $18 billion, it really drags up the average. Their debt to equity ratio is average. They pay a nice dividend, more than everyone on this list except for the French oil giant Total Energies. They pay 6.8%. Their free cash flow is lower than average. Their market cap is half what the average is because Exxon is so big. They do have really good price multiples, all better than average. Revenue of $43 billion, average is $118 billion. Their revenue growth is also lower than average, which is not great to see, but it is in line with these top 3 companies, better than BP, and they have a really good ROA and ROE. ROA is net income over assets. That's how well you use your assets to generate a profit. ROE is net income over equity. It's how well you use your equity to generate a profit. Equity is assets minus liabilities. So to summarize, I have them trading at 11% discount. They killed it like most oil and gas companies in 2022. I ranked their free cash flows 9 out of 10, their revenue 9 out of 10, and their ratios 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.